Welcome to this high-energy explainer. Today, we're breaking down the biggest public offering since 2019, the historic SpaceX IPO. We're going to look at both the staggering hype and, well, the sobering financial realities surrounding it. Real quick before we dive in, please remember this is strictly for informational purposes, and I am absolutely not a financial advisor. All right, let's get into it.
Okay, we really just need to pause for a second and look at the sheer unprecedented scale of this thing. SpaceX is targeting a jaw-dropping $1.75 trillion valuation. They're planning an $80 billion raise with the stock price at a fixed $135 a share. To put that into perspective, an IPO of this massive magnitude doesn't just make waves, right? It entirely reshapes the financial landscape around it.
To really wrap your head around this mega-cap listing, just think about this comparison. SpaceX is going public at a higher valuation than Boeing, RTX, GE Aerospace, Northrop Grumman, and literally all other S&P 500 aerospace companies combined. Those 12 legacy titans together, they're valued at roughly $1.5 trillion. So SpaceX is essentially demanding a premium above the entire established aerospace sector. It's wild.
But here's the catch. The numbers show a massive disconnect in the actual fundamentals. Those legacy aerospace giants we just mentioned, they generate $500 billion in actual revenue. Meanwhile, SpaceX is sitting at reported pre-IPO revenues of just $18.7 billion. That is an enormous gap between current financial performance and market valuation, which is exactly why this IPO is being so heavily debated right now.
Which brings us to Section 1, the siphon effect on space.
So when a whale this big enters the market, it creates massive capital gravity, what we call an immediate siphon effect. The numbers across the board are taking a hit. Competitor Rocket Lab plunged 13%, Virgin Galactic fell over 37%, and others like Firefly and AST Space Mobile saw severe double-digit drops. Basically, retail and institutional investors are desperately liquidating their transitional holdings in these smaller space stocks just to free up cash so they can grab that new SPX ticker.
And honestly, the siphon effect isn't just hurting the small space stocks. As passive funds and benchmark tracking portfolios prepare to aggressively buy the stock to maintain their index weightings, we're seeing severe liquidity sensitivity and rotation risk impacting the heavyweights too. We're talking about potential trimming in mega caps like Microsoft and rotation out of crowded AI leaders like Nvidia just to fund this historic allocation. It's like a giant financial vacuum.
So, let's move on to Section 2, the tech driving the valuation.
To understand why the entire market is scrambling to rotate capital for a company with only $18 billion in revenue, you've got to look at their tech moat. SpaceX effectively solved three impossible hurdles at once. First, they mastered reusable rockets with the Falcon 9, drastically cutting launch costs. Second, they democratized military-grade phased array antennas, crushing the manufacturing cost down to under $500 to actually make Starlink a viable consumer product. And third, they brought an automotive-style assembly line to space, pumping out an unbelievable 6 satellites every single day. Now, the real engine of this valuation is the math on Starship's reusability. When you look at the projections, the internal cost to orbit practically falls off a cliff. With Falcon 9, they pushed it down to $756 per kilogram. But with Starship, under this moonshot reusability scenario, that cost is projected to get slashed down to an unbelievable $67 per kilogram. This structural cost advantage, that is the core engine driving their massive valuation.
And they're turning all that cheap launch capacity into a revolutionary global network. By equipping satellites with inter-satellite lasers capable of moving data at 200 gigabits per second, they're beaming information faster than undersea fiber optics. Add in direct-to-cell technology, which literally turns satellites into orbital cell towers for existing LTE smartphones, and they're effectively eliminating global network dead zones. It's a total game changer.
All right, that brings us to Section 3, the bullish Netscape moment.
So, you might be wondering, why are venture capitalists predicting this IPO will actually lift the entire space industry rather than just cannibalize it? Well, Chad Anderson from Space Capital perfectly captures the bull case right here. He calls this space's Netscape moment. Just like Netscape proved the internet was a viable commercial market, this IPO validates deep tech hardware. It creates a massive liquidity event that'll recycle wealth back to founders and engineers, sparking a huge new wave of space startup investments.
And optimism in this camp is just incredibly high. Legendary investor Ron Barron is so bullish that he predicts the company could reach a mind-bending $30 trillion valuation in the future. I mean, let that scale really sink in for a second. $30 trillion.
To the bulls, SpaceX isn't just launching rockets, they're building the fundamental highways of the next digital and physical frontier. But the ultimate bull thesis relies entirely on one specific trajectory: scaling Starship. To justify all this hype, SpaceX has to achieve roughly one Starship launch per day by 2035. If they can deploy hundreds of massive satellites per launch, it unlocks this highly lucrative orbital AI data center narrative. And that is exactly where the tech giants of today start seeing SpaceX as a direct peer tomorrow.
However, let's flip the coin. Section 4. Morningstar's bearish reality check.
Because look, not everyone is buying the hype. Financial experts like NYU's Aswath Damodaran, who is often called the dean of valuation, have explicitly stated they'd stay away entirely. And objective math paints a very different picture. Morningstar conducted a rigorous probability-weighted discounted cash flow analysis, and their fair value estimate prices SpaceX at just $63 a share. That is a stark 53% discount compared to the IPO's asking price of $135. So from a purely mathematical standpoint, the shares appear massively overvalued.
Let's actually break down exactly how Morningstar gets to that number. They value the core space and Starlink business at just $40 a share. To justify that $135 price tag, investors basically have to bank on a flawless moonshot scenario where orbital AI data centers succeed perfectly. But Morningstar, they assign that moonshot scenario only a 7% probability of actually happening. 7%.
You can clearly see the premium SpaceX is demanding here. When you look at the price-to-sales multiple at IPO, SpaceX is demanding an astronomical 94 times revenue multiple. That completely blows past historical tech debuts. I mean, Google went public at 12 times revenue. Meta was at 22 times. SpaceX is operating in a completely different and arguably unproven financial orbit.
Ultimately, bearish analysts argue that buying in at $135 today means you're paying a massive $72 per share option premium. You're paying upfront for unproven hardware, theoretical AI orbital infrastructure, and planetary ambitions like Mars colonies that realistically won't even begin to materialize until at least 2028.
Which brings us to our final part, Section 5, a giant leap of faith.
We've seen the undeniable technological marvels SpaceX has built, right? Slashing launch costs, completely reinventing global connectivity. But that is juxtaposed directly against the terrifying, unprecedented valuation multiples required to actually participate in this IPO. Which leaves us with the ultimate question as the opening bell approaches for the largest public offering since 2019. Are we witnessing the inevitable dawn of a boundless orbital economy that will lift an entire industry? Or is this simply the most expensive leap of faith in Wall Street history? That's what you have to decide. Thanks so much for joining me on this explainer, and keep questioning the data.